what's gone before with our first two dialogues. So we've been looking at what a future low carbon energy system looks like, and what is the grid capacity that we need to sustain a low carbon grid, particularly one with a lot of renewables on it. And now we're digging into the financing issues. And we've got a lineup of speakers, which our chairperson will introduce. So it simply remains for me to introduce Joanne Bate to you. Joanne is one of our commissioners, so she was appointed by the President to serve on the Presidential Climate Commission. She does have a very important full-time job, which is acting as the Chief Operations Officer for the Industrial Development Corporation. And amongst others, she's driving a whole lot of the investment that's taking place, linked to the green economy, the future hydrogen economy, and many low carbon and renewable energy projects. So it gives me great pleasure to welcome you, Joanne, and to hand over to you as chair.
Thank you so much, and thank you for inviting me to chair this very important conversation. So from an agenda perspective, we have some very interesting people sharing with us their perspectives today, and I hope that it's going to invite some very open and interesting and challenging dialogue. We have the context framing, or the PCC context framing, initially from Deepak, and Deepak Patel is the head of Climate Finance and Innovation at the PCC. So Deepak, can I hand over to you? Thanks. And I'll introduce the other members as we go along. Thank you.
Thank you, Joanne. And welcome everyone to this third in the dialogue series on energy. I've taken the liberty to call it, this one at least, the Power Finance Dialogue. And we hope that with respect to finance, funding and investment, this will be the first of many deep dives that we undertake. And so from our perspective, we're seeing this as a conversation taking place with people who have been applying their minds to these issues over the last year or 2 years and providing that perspective to us. So essentially, it is to understand the imperatives for financing South Africa's just energy transition. The key topics we're hoping to cover, if not in depth, certainly to begin to explore. Firstly, how much money do we need through our transition and in what periods of time? Here, the PCC provides independent advice on key issues relating to climate change as well as the just transition overall. And we've noticed that a number of estimates have been produced with differing carbon budget and pathway assumptions, and we're going to try to unpack some of those. Of course, the key question is, where will this money come from? Where could it come from? And again, we are aware of domestic as well as global capital, financial, grant and concessional markets, as well as how the private sector, under the right conditions, can begin to make a contribution to ensuring that our just transition is adequately financed and invested in. And then, of course, the whole issue of financial products, financial innovation, and particularly as it relates to differentiated risk, how do we begin to broaden and deepen South Africa's access to capital markets through innovation? How much money we need? That depends on the emissions pathway we choose, or the pathways we can choose from amongst options, the capacity of our own economy and society to transition, and of course, the pace at which we do it. And this, particularly in the period up to 2030, when the common wisdom is beginning to tell us that we need to set the stage by 2030 to begin to give practical, realizable, and implemented effect to our endeavors to decarbonize to net zero by mid-century. The NDC is a voluntary commitment that we made as a country into the UNFCCC framework last year, and it in fact goes further in its ambition than what we presented as a country at Paris in 2015 and 16. And all of you on this call, I have no doubt, are by now familiar with what the ranges look like. In terms of our commitments, we also made commitments which give us a range to 2030, and this range is between 420 and 350 million tons of CO2 emission by that date, with pathways taking us to net zero by 2050 or mid-century. In terms of attempts to quantify what the ask would be, what the requirements would be from an investment as well as a costs point of view, a number of organizations as well as modeling teams have taken a stab at this. I'm not going to go into the details, safe to say that apropos my earlier comment, depending on what kind of carbon budget we assume, firstly, to take us to 2030, and then secondly, to take us to net zero, along pathways that might be steeper than others. System IQ, and in particular, the Blended Finance Task Team, have attempted a quantification of the costs associated with decarbonizing our electricity and power energy sector. NBI, through its study with BCG, has also come up with estimates. These are largely top-down or bottom-up estimates, while the UCT study on a macroeconomic modeling basis has determined what an economy-wide investment and costs, both public and private, including households, would look like. I'm not going to go into the details of the numbers because, as I said earlier, depending on the assumptions we make, we could come up with different numbers. What is quite interesting, though, is that all the elements that make up the decarbonization endeavors in our electricity sector in particular are fairly united with respect to what those elements look like. Renewable energy, a rapid rollout, storage, battery as well as pumped hydro, again, investment to scale. You'll notice that zero is in the NBI and UCT. That's not because they don't believe in batteries and storage. They've just taken a view that that would come later. Gas plants, obviously a controversial subject, but all of the serious modelers have made an assumption that at least for peaking requirements, there will be a need for gas. And again, depending on the assumptions about the role and the duration over which gas would play a role, there are estimates. Transmission and distribution, there is absolute consensus now that there needs to be creative as well as urgent mechanisms found to both finance and roll out an extension of and a strengthening of the grid. Green hydrogen, again, consensus, except of course, some believe that in terms of its contribution to decarbonization and therefore the investment needs, it might be later than 2030. The JET PIP, that's the investment plan being formulated by the Presidential Climate Finance Task Team, is under construction at the moment, and it would be very interesting to see what estimates they come up with. The World Bank CCDR, in a very early expression to us of what they believe the investment should be, is also coming up with estimates. What we can see is that the estimates up to 2030 are absolutely united. They are reasonably consensual, and they make a case for a rapid mobilizing and scaling up of climate finance. The years 2030 to 2050 are going to depend on a variety of mechanisms, and the PCC sees itself as being quite an important player in attempting to corroborate as well as bring some degree of consensus with respect to what these pathways would look like. Where could the money come from? This is perhaps an oversimplification, but we know that in broad terms, there are only four sources of money. One, the consumer paying for services rendered and therefore also paying for the infrastructure that is required to be put up for the provision of those services. Two, the taxpayer through the fiscus and through the increasing of tax, as well as potentially special taxes being levied, could also be another source of this funding requirement. Thirdly, debt, both public and private, but we all know that unless these are underpinned by revenue, they normally would not be raisable because of the need to in fact pay back with interest. And then of course, equity, a slightly different risk category. In terms of South Africa's borrowing capacity, I thought I'd just put this up because as we look to global markets, and in particular, as we look to raise resources in hard currency terms, here we find that increasingly it's going to become difficult to raise affordable financing from the markets, unless of course we find creative ways of getting concessional financing through the sovereign and via bilaterals and multilaterals with potentially donors. In terms of the household savings rate, this again is quite critical to ensure that our overall national savings rate allows us to have a degree of savings where institutions as well as pension funds can begin to hopefully leverage some of their capacity based on the savings rate. We believe in the PCC, and I'm sure that the speakers who follow will concur with me. We need a blend. We need all of these four potential sources of finance blended appropriately for different types of projects, for different types of purposes, in a way that follows the needs of our transition. We need a cost-reflective tariff as part of the mix. We need to minimize the pass-through to vulnerable communities, and that is quite a key component of our just transition framework to ensure energy security accompanies our decarbonization endeavors. We must ensure that investment creates national revenue, economic growth, and through that process, enhance the tax revenue base. There is limited government headroom, as we all know, due to the fiscal constraints, and this is a limitation within which we need to work by ensuring that private sector capital sources are maximized in terms of mobilizing and scaling up. We, of course, then need to increase the distributional outcomes, and private savings is essential for equality. How do we get it? What innovations do we need? Here we are taking a stab, so to speak, at what leverage could look like. And we've simply used the 8.5 billion on the assumption that the bulk of it is grant and deeply concessional. And there is a view that the ratio could be somewhere between 6-to-1 or 9-to-1, allowing us, if that 8.5 billion were in fact grant and deeply concessional, to potentially leverage that up to R1 trillion. This simply sketches the ecosystem and the point that I made earlier, and that is there needs to be harmonization, where necessary, integration, but certainly alignment between all of the players who either provide the funds, who can play a role in the policy as well as the regulatory environment to enhance those in order to attract funds from the private sector. And finally, the question as well is with respect to local governments and authorities. As we know, they will play a critical role in implementation of the just transition because of their locality governance, and we all know that projects eventually will be located in local areas. And with that, I will simply end with this slide, where we know that there are $8.5 billion of commitment made by a group of 5 parties, that is the United States, the UK, France, Germany, and the EU, and it will be a test. All eyes are on South Africa to provide both the pathways as well as the means through which to ensure that we are able to crowd in, compose, properly structure through a governed and institutionally robust process, use those resources for catalytic effect. Providing that overall outline of what drives the PCC perspective in the area of climate finance, I want to hand back to Joanne, who will introduce our keynote speaker, Mark Swilling. Thank you.
Thanks so much, Deepak. And it always is quite overwhelming to see the scale of need where it comes to the electricity sector alone, and add to that the other decarbonisation pathways. It really is a mammoth task ahead of us. The great opportunity with the 8.5 billion, it certainly focuses on our mind on finding a solution. So Mark, how do we think about energy finance development and the just transition? Thanks.
Thanks very much, Joanne. Thanks, Deepak and the PCC. I'm going to try and answer that with a discussion. And let me just find my presentation.
And while Mark's doing that, I did say I would introduce him. I suppose he needs no introduction. We all know Mark from Stellenbosch University, DBSA board, and other key roles that he has played, and a voice that I think is very well respected on the subject. So thanks, Mark.
Thanks, Joanne. So I'm going to be really drawing on and building on a report that was jointly developed and published by my research center, the CST, and the Blended Finance Task Force. But I'm also going to be drawing on my experience on the DBSA board over the last 8 years, during which we have substantially increased our involvement in the funding of the energy transition. But I'm talking in my personal capacity, of course. So, I mean, the starting point, I think, really does need to be a recognition of the point of departure here. Which is the substantial rise in investments in renewable energy over the last 20 years. As you can see here, new capacity in non-renewables is declining and massively increasing in renewables. And renewables as a percentage of new capacity is now over the 75% mark. And obviously the question for us South Africans is, do we want to miss this boat? The driver needs to be recognized. It's not just a case of adherence to climate targets, which is often how this debate gets discredited by those who are opposed to the idea of the energy transition. The driver is very much got to do with economic drivers, and in particular reflected in prices. So on the left-hand side, it's just a rapid summary of the drop in prices of the key technologies, including the very dramatic drop in battery prices over the last decade or so. And that battery price drop is really important if we want to build an integrated renewables-based grid, which can also respond to the need for proper base supply. I'm not going to use the word base load. So in terms of financing, this is a summary of the overall disinvestment from fossil fuels that has taken place in recent years. 140 global banks, insurers, investors have made disinvestment announcements. South African banks, in the word of one senior banker, make funding calls very, very difficult. The hurdles are very high. General Electric, for example, is no longer going to be building and supplying equipment to coal-fired power plants. And the International Energy Agency, as we all know, has called for a halt in new fossil fuel investments. And China has declared it won't be funding coal outside of China. The Net Zero Asset Managers Initiative, which was announced at COP26, brings together asset managers like BlackRock and many others who, between them, control assets of 130 trillion, 450 signatories, 45 countries, and the biggest sovereign wealth fund, Norway, has basically been instructed by the government to withdraw from the 9,300 companies that they are invested in if they are in fossil fuels, which not all of them are, of course. So it's really to do an audit in order to reevaluate, revalue their portfolio. Just in terms of the estimations of the growth of the different sectors through to 2050, this is the Bloomberg assessment, New Energy Finance, which revised upwards the assessments for solar and wind, and revised downwards the estimates for coal. But you can see where we get to by 2040, and obviously through to 2050, a picture of a renewables-based grid by 2050. What's interesting when you look at the funding, especially during the early years of this century, when you look at the funding, this is work by Mariano Mazzucato, which really does show on the left-hand side how private sector investments have been enabled by a rise in public sector investment. So as opposed to the traditional assumption that the public sector does R&D and stays out of the economy once the technologies are proven, what this work shows is that between 2004 and 2014, public sector investments enabled the rise in private sector investments, because public sector investments tend to go into high risk technologies, which then become low risk over time, which then enables the private sector to move into lower risk technologies and increase their market share over time. And on the right-hand side is the same basic picture, but without the Chinese state-owned banks. So coming to South Africa, we all know this story, which is the dependence on coal, the global average of 34% and South Africa 86%, as opposed to the picture on the right-hand side, which shows the extraordinary resources that we have in South Africa, or Southern Africa, in terms of both solar and wind. So that's really the point of departure for thinking in ambitious terms about an energy transition, and drawing on the Meridian economics research, which shows on the left-hand side the ambitious coal closure pathway through to 2040, and on the right-hand side a representation of the savings in terms of mitigation of carbon emissions, which in this diagram is 1.4 gigatons. So this is really the background. So in a sense, the starting point for this financial analysis is this ambitious mitigation target, which is in line with the NDC. The NDC target emissions range, as Deepak has already referred, is between 350 and 420 megatons of CO2. And the lower range is equivalent to 1.5 gigatons saving of carbon emissions. So the total RSA emissions is in 2020 was 540. And that includes forestry, land use, and transport, and the power sector is at 200. So if all other sectors remain constant, the power sector is going to have to lead. But it also makes sense, because it's going to be very expensive to decarbonize the other sectors. But if they electrify as much as possible and the power sector decarbonizes, then they benefit financially and environmentally from the cheaper decarbonized power provided by a reformed or decarbonized power sector system. So the ambitious coal-off scenario of 1.4 gigaton saving by 2040 basically enables us to achieve the lower end of the NDC target range. At the same time, we can't just focus on decarbonization, even if it is driven by a lowest cost requirement. We obviously have to make sure that it's a just energy transition, bearing in mind the number of workers employed in the coal value chain and how many dependents there are, and the diverse dimensions of the just transition. And this obviously is of particular significance for the Mpumalanga region. So at the center of the report that we released in June is this breakdown of the estimate, which Deepak has already referred to. 7 basic elements: the renewable energy build out at 100 25 billion, 160 gigawatts, mainly privately funded. The second and third is really your flexibility infrastructure, i.e. your storage, estimating at roughly 50 billion for battery storage, 33 gigawatts, and gas at 30 gigawatts. And that's a gas infrastructure which would be activated for a minimal period of time, really as backup for your national renewables-based grid. So it's a large infrastructure, but maybe 5% of total energy would be from gas in such a system. Fourthly, your transmission and distribution. Our initial estimate was 40 billion, but in interactions with the ESCOM grid planners, it became clear that it's probably a 10 billion more than that, because you have to factor in rehab, and you also have to take into account distribution, the distribution grids. Fifthly, green industrialization, which we haven't costed. This has been extensively debated, but it's what we need to really be mindful of, learning from bid window 5, that if the prices are pushed down too low, it makes upstream industrialization increasingly difficult. It'll be good for Chinese workers if we import the kit, but not for South African workers to build cheap utility scale renewable energy infrastructure. So this balance between what price level would be appropriate for enabling upstream industrialization becomes an important discussion and debate. The sixth is early retirement at 24 billion. And then the climate justice outcomes for workers and communities, which obviously overlaps with green industrialization, would be at least 10 billion. So to put that number into perspective, the National Infrastructure Plan 2050 is estimated, which was approved by Cabinet, a 4.4 trillion investment in the energy and transport sector, 70% of which is energy. So we're in the ballpark in these kinds of estimates. If you look at generation only, we through to 2050, that's 175 billion. But through to 2030, we're looking at $45 billion. And that is obviously the focus of this discussion and needs to be correlated with the kinds of investment potential, which I'll come to in a minute. We can't obviously separate generation from the grid, and fortunately, over the last year and a half, the grid has become a prominent part of the discussion. Up until recently, it was like the Cinderella of the energy transition, which is unfortunate because although it's only maybe 10% of the total investment required through to 2050, it is the hinge on which the big door swings. And it needs to be done, a lot of it needs to be done up front. So what we're looking at here is familiar to quite a number of people here. Obviously, the REDs, which are the renewable energy development zones, which are going to become increasingly important for in the upcoming years, because we have to accelerate approvals in the context of relaxed environmental approvals, and that's going to become possible within the REDs, and the REDs are linked together by the corridors. But I think what we really need to take into account when we're having the finance discussion is that our current build rate is about 400 kilometers per annum. During the height of our energy build-out program in the 70s and 80s, we hit 1,200 kilometers per annum. And if we translate the ambitions for the renewable energy generation that is required in the relatively short term, we really have to ramp up very quickly to 1,500 to even some estimates 2,000 kilometers per annum. And we've just started a research project to interview all the companies in this business to say, what is it going to take for you to double, never mind triple, double your output? And it's an important set of questions that need to be answered. So what we then did in this report is to take the 7 categories that I referred to earlier and say, okay, given this 250 billion investment program through to 2050 to hit these targets, which excluding an estimate for green industrialization, where does the 8.5 fit in? And in our view, on the right-hand side, we really do think it makes a lot of sense for the 8.5 billion to be focused as far as possible on the transmission system and early retirement. It doesn't make a lot of sense, except possibly on Eskom's repowering plants, repowering projects, to focus any of that investment on new renewables, given the private sector capacity for that. So that's really just a summary of a more detailed summary of the estimations that we have done and where the 8.5 could be focused. So this is the really controversial stuff, and this is really a rough guess. It's a kind of educated guess based building on our work and on other work that is being done to say, okay, what does it look like through to 2030? So funding for bid windows 5, 6, and 7, assuming they're going to average out at that from 6 and 7 is going to be around 5 gigs each. You're looking at, and if you make the assumption of 1.6 billion per 100 megawatts, it's a 284 billion rand investment. If you look at the DFIs and the PIC, the DBSA and the IDC respectively their books are at 100 billion, 120 billion. The PIC is at 2 trillion. If we assume 20% of the books of the DFIs and 10% of the PIC, that brings it to 280 billion. If you look at the 9.2 gigawatts that Operation Vulindlela referred to after the president's announcements in July, unguaranteed, non-REAP at 147 billion, which is quite similar to what the private sector invested in the first 10 years of the REAP. International donors, roughly at 100 billion, maybe that's a bit of an estimate. The multilateral development banks at 50 billion. I don't think we want to push that up too high if it's dollar denominated. And just transition funding, which should ideally be grant and state funding at 60 billion. So if you look at that 922 billion in relation to the estimation of 675 billion needed for generation through to 2030, plus what is required for investments in the grid, which some have estimated as immediately requiring in the area of 130 billion, and you take into account the costs of decommissioning or repowering, depending on how you see it. These figures seem to be correlating with some of what Deepak was referring to. I'm not sure we want to ramp up external dollar-denominated debt above 20%. And I think, although DFIs have been critical in the investment in IPPs thus far, my view is we should be moving out of that and into investing in the transmission and distribution grids and leading the way there. So the exact numbers, I think we should rather get together, the key players, and really thresh it out, so that it's not just a public sector discussion. In terms of the different kinds of instruments available, we shouldn't focus just on cash. We should look at all the different catalytic instruments that are available in order to manage the risk over time. And I'm not going to go into those. We're all, in one way or another, familiar with all of these different mechanisms, but how they are judiciously and creatively mixed and matched talks to the constraints that Deepak referred to when it comes to our rating and our access and our capacity to absorb debt, in particular external debt. As far as the donor principles, the donors are concerned, in this report we talked about these 6 principles, which we think are really important if South Africa is going to be able to negotiate a constructive relationship with the donors, and that is really what the task team is all about, and we're all waiting for the outcome. But the principles would be embedding transparency and accountability in the donor pledges, and that means making sure that there is a clear line of sight for South Africans on what's really going on, establishing donor coordination and standardization mechanisms rather than everybody doing their own thing, which really draws on our limited capacity to an extent that I don't think we can really handle. Make greater use of the catalytic instruments that I've already referred to, rather than just focusing on capital transfers. Ensure donor funding is complementary and coordinated with, in particular, investments by South African DFIs, the PIC, and the private financial institutions. Use demand to guide funding allocation rather than just the replication of top-down assumptions of what's needed, and then shift decision-making power so that there's an internal South African coordination mechanism in place. So all the different parties that are already engaging to accelerate the energy transition in line with the President's July statement. And I don't need to refer to any of this in any detail whatsoever, because this is the TCC's core business. But what I would like to say is that based on the research that we've been doing, led by Ntabiseng Motlakwana, is in the Mpumalanga region, is that there's very, very low levels of trust in that province when it comes to government statements, government pledges, government programs. And without interventions that are going to rebuild trust within those affected communities, I think we're going to really face very substantial problems if we are serious about the just transition. So let me end there, and hopefully it complements other inputs and we could have a really good discussion. Thank you.
Wonderful. Thank you so much, Mark. And that builds on very nicely from what Deepak was saying. And I think that the trust deficit in communities is going to have an enormous impact on the speed of execution and the ability to bring people along. So I think it's such an important point. And the need for both public and private sector to work together. This isn't a public sector only solution that needs to be put in place. This is very much a collaborative requirement. And that's why I do think the PCC is so beautifully designed to actually enable those government, social and private sector conversations. So thank you very much, Mark, for your perspective. And we're now going to move on. We've seen from the previous presentations the enormous need for the banking sector to come forward in a significant commercial funding opportunity. So Judy Querbus is joining us from the infrastructure finance team at Rand Merchant Bank. So Judy, over to you, and thanks for joining us.
Thank you, Joanne, and good afternoon to everyone. So somebody else is driving my slides, so we can move on to the next slide, please. Okay, so as a way of introduction, the need with regards to coming out of this energy crisis is immense. Depending on who you talked to, I mean, the indications are that we will require, let's say, 1.2 trillion rands between now and 2030 to basically come out of the energy crisis, and also to transition the energy mix within SA. And when we look at the slide, I mean, the bulk of this is for generation capacity. And it is true that now the grid is also getting quite a lot of attention, with the remainder dedicated to the grid. So according to Eskom, the requirement until 2030 is an additional 50 to 60 gigawatts of renewable energy. And the bulk of this renewable energy will have to be delivered by the private sector, given the fiscal constraints that the country is currently facing. So we can move on to the next slide. That said, when we look at what has been delivered to date, the private sector has historically had a lot of appetite for infrastructure assets broadly and electricity assets in particular. And that is evidenced by the fact that since the PPP framework was created, we have attracted over 95 billion rands of private sector investment into that sector. And in the renewable energy sector or the energy transition sector, we are currently having support and mandates of circa 400 billion at this point in time. That said, I mean, what we can see in this slide is that the bulk of the amount was delivered in REAP round 1 to round 4, where 200 billion, circa 200 billion was attracted from the private sector. But what's important to note is that the appetite, the private sector appetite for infrastructure assets and renewable energy assets or transition assets in particular has always far, far outstripped the pipeline or the deal flow within that sector. So that 200 billion that was attracted for the renewable energy IPP program between rounds 1 and 4 was actually for bids that were bid between 2011 and 2015. And since then, there was a dearth of deals that were coming to market in the REAP program, with RMIPP only being bid in 2020, late 2020, and REAP round 5 only being bid last year. So what that means is that if there was a consistent pipeline of projects that was continuously coming to market, there would absolutely be private sector appetite for both debt and equity to fund those deals. And to add to this picture, when you look at the slide, you see that RMIPP that was bid in 2020, as I said, REAP round 5 that was bid last year, and REAP round 6 that's currently open for bidding, are comfortably attracting circa 200 billion of private sector investment, basically doubling what was done over the last 10 years. So this thing shows that what has been done in the past is not necessarily indicative of the capital markets appetite for infrastructure assets, particularly just transition assets in the energy space, right? The things that made REAP successful in the, I would say, probably in the first half of the decade when it was bidding, was that there was certainty around the planning and the pipeline. So the market had started anticipating that there was a pipeline of deals that were going to flow into the market. And I remember there was 1 year, I think it was a year when round 3, was being bid, where we had 2 rounds and the market was able to absorb the capital requirement associated with 2 rounds of bidding. Okay. And what that had led to as well was that we were also starting to see local capacity being built. So we had started seeing local PV assembly plants, and they were moving towards manufacturing plants. We were starting to see a wind turbine generator towers, the concrete towers, being generated locally. But then the delay between the bidding of REAP round 4 and REAP round 5 actually then resulted in a number of players that had actually entered the SA market in anticipation of the renewable energy program actually exiting. The other thing that made REAP successful was the reverse auction nature of it, which allowed that the tariffs reduce as demand from the private sector in terms of winning these bids increased over the years. And it is a true success story when you look at the cost of renewable energy and how it has gone down over the last decade. And then also, as I've mentioned, there was certainty around when bids were going to come, right? And then when you overlay now the lifting of the threshold over which a generation license would be required, so talking to now private power, what we've seen in our space, in the corporate and commercial space, being led by the energy intensive users group in particular, so entities in the resources sector in particular, like mining houses, is that we've seen that about 163 billion of projects are currently being bid or have been awarded in the private power space, which basically says that currently we've got power projects as banks that are the pipeline is sitting at about 400 billion that we need to close, let's say, within the next year or two. So live projects that have been awarded that are currently in the process of reaching financial close. And to comment on that is that, I mean, what we find in the sector is that the biggest players with regards to providing just energy transition financing are still currently the banks. We still have some institutions in the form of asset managers that are playing in the space, but those asset managers are the usual suspects that have played in infrastructure. I mean, since the toll roads that were awarded and constructed in the late 90s. And we haven't seen we haven't seen entrants, new entrants really looking for infrastructure debt or equity. And notwithstanding that the market has remained stagnant, we've been able to absorb all of this activity. That said, I think that the regulation 28 amendments are positive. So I think we can move on to the next slide. Sorry. The regulation 28 amendments are very, very positive for the sector, because then we start really attracting pension fund money at scale. And there I used a case study of the special purpose acquisition companies. Sorry, I'm on the next slide. So I used an example there of the special purpose acquisition companies, the SPACs that were listed in the JSE, which actually failed to reach the levels that they anticipated at the IPO stage. And the model around the space was such that we would have this entity that invests in renewable energy assets, have it listed so that it can attract proper institutional money, so capital markets money. And in that process, we had a number of learnings that the market was not necessarily interested in investing in the asset class, because of the fact that there wasn't visibility in terms of the pipeline. So the specs that were listed, basically what happened to them is that instead of them having an increasing NAV, because they're constantly loading new projects, onto their pipeline, we found that the NAV is decreasing, especially given the gap between REIT round 4 and round 5. And then we also found that asset managers that are not typically in the space, for them to enter the space and bring the pension funds along with them, they do require pipelines. So they do require a sizable pipeline for them to be able to invest in the space. And then they also do require certainty around delivery. So I think that the message I'm trying to portray here is that the private sector will find the money, especially for the numbers that have been detailed in the market. But for the private sector to be able to find the money, we do need certainty around the pipeline. We do need to understand that that the deals will be delivered in a format that is bankable. And then the banks will crowd in the pension funds, because banks are no longer the long-term holders of these types of assets. And the roles that banks play is to originate, package, and see these assets through the de-risking phases of the construction phase, and then sell them off to the pension funds. And I think that whether you're funding it through government in a blended finance method or through the private sector completely, the philosophy is the same, that you need a custodian of these assets whilst they are being structured, because they are quite complex. Whilst they're being structured, you need someone to be able to package these assets, see them through to construction, and then post them de-risking, then have a capital market that is able to take them. And that means then that maybe capital is definitely a component of it that we need to concentrate on, but it's not necessarily the bottleneck in terms of the delivery of infrastructure in SA, particularly our green infrastructure in SA. And that maybe we should also focus then on how the deals would need to be structured such that the market can actually take them. I think going on to that point, I think that there are a number of thoughts that the private sector has around how we can make sure that we have the capital available to fund just transition, but it requires certain trade-offs as well that I think we as the private sector and government would need to discuss. Some of the trade-offs, for example, is that when you look at REAP Round 5, the REAP program in general, so that 209 billion that has been raised at the back of a fiscal guarantee. So a REAP is guaranteed for certain default scenarios by government. But when you look at the 163 billion of deals that are being done with the private sector is not providing guarantees that are as comprehensive as what we are getting from the public sector. But then that also has an implication in terms of the nature of documents and the nature of the agreements that are concluded in the REAP program, for example. So there are certain amendments that can be done in the suite of documentations that can actually release a lot of the fiscal guarantees that are currently being given. So for example, we are seeing guarantees, let's say, of about 3 to 5 years from off-takers in the private sector market. However, in the programmatic government programs, we are seeing guarantees that are there for the full 20-year PPA term. And that's a result of, the reason for that is because of the clauses or the requirements within the legal documentation. So I think that there is some work that can be done such that we can free up, the fiscus and use private sector money more to deliver infrastructure. But then that requires much more open dialogue between government and ourselves. The other way in which we can look at funding infrastructure in a fiscal light way is also introducing alternative guarantee mechanism where it's required, like put call agreements, which are very, very common in the rest of Africa. And then also, I think the other speakers before me have mentioned that blended financing maybe is the way to go, where you do get some concessional financing at the bottom that maybe takes a first loss position or takes a view maybe on the less bankable components of a deal, and then you galvanize the private sector then to basically fund the rest of the program. But it does require a much closer working relationship between the banks, the institutions, and government to resolve. Okay, next slide, please.
Judy, if I could ask you to start wrapping up, please.
Perfect, because it's a conclusion slide. So in conclusion, what we're saying is that as the private sector and as banks in particular, I think that we have been very instrumental in delivering the renewable energy program, whether it's the LEAP program, whether it's through, I'm sorry, can you guys hear me? Sorry, I think I got a phone call.
No, you're perfect.
Thanks. So whether it's through the REAP program or private power, there is absolute appetite from the private sector to absolutely fund the capital requirements that we have, as has been displayed. The issue is around pipeline consistency of delivery around that pipeline. There are ideas in terms of how we can implement infrastructure without necessarily looking for government guarantees that are as onerous as what we have seen in the past. But then what that does require is that we need to capacitate government to be able to deliver the pipeline, in a predictable and understandable way so that the private sector can plan for it. Okay, that's me.
Wonderful. Thanks very much. And I think what you're saying is probably music to the ears of our Treasury colleagues in looking at how we can mobilize commercial financing in a fiscally prudent manner. So some great suggestions there. We have eaten a bit into our Q&A time. So I'm going to there's a number of questions relating to the 8.5 billion. And I'm going to ask, we'll see at the end if there is time for Chantal from the Presidential Climate Finance Task Team to provide some update. Actually, I think she's on the agenda, so apologies, so she can provide some input there. So we won't address that as part of this part of the presentation. And Judy, there's a question related to private sector funding for transmission and just transition. What is your thinking? You did touch on that, but I don't know if you've got a thought that you want to add on that. And then while you're answering, maybe Mark, you can think about Judy's comment on the need for this program to be delivered, that it seems like there's ample capital provided we are able to deliver on the program. So how do we ensure that we deliver this integrated planning to effect delivery? What are the hindrances and enablements that would allow us to do that? But Judy, starting with you. Thanks.
Yeah, thank you. So I think that there are a number of considerations around this because, there are sensitivities around privatizing the grid in certain pockets. So there are many ways in which the investment that's required for grid infrastructure can be raised. One such way is the PPP framework that's been around for a long time, where the infrastructure still remains the property of government, but we crowd in the private sector in terms of money and skills to basically deliver the expansion works and the O&M works, so operations and maintenance works that are required, whilst at the back of maybe a unitary payment type structure, instead of maybe then the private sector taking it over. Otherwise, we can also look and we are seeing a few of these types of projects coming out in the private power space, where we are starting to see mini grids or almost like what we call private grids coming up as well for private power. But I think that the message I'm trying to give out there is that I think as a country, we are very, very, very far from the point where the infrastructure delivery is hindered or is slowed down because there is no access or there's limited access to adequate capital. I think that the issue is more about creating funding structures that take into account the key considerations from government and also from the private sector to make deals bankable. But there are many ways to kill this cat, as I would say. but it just requires conversation. It also requires PD delivery as well.
Very much agreed. Thank you very much, Judy. And Mark, I'm putting your other hat on today in the NPC to help us think about how do we actually build this integrated plan and ensure that we execute against it.
Well, I mean, obviously the ball game changed in July with the president's statement, which was based on quite rapid but quite deep consultation with key stakeholders and putting in place the steering committee and supported by Operation Vulindlela. We have capacity now to actually start joining the dots and making things move. I think that is a crucial step in the right direction. There's the unbundling process on the Eskom side is key for making sure that the transmission entity is set up and the transmission assets transferred, so that entity can then start attracting the kinds of investments that are absolutely critical for attracting investment into the grid, which then unlocks and opens up. For example, the Northern Cape, at very best, there's 100 megawatts of extra capacity in the Northern Cape, where so many great resources are located. Those kinds of constraints need to be addressed, and they can be addressed quite quickly. The transmission entity obviously has to be set up properly. It can't be burdened with too much debt, which then locks it out of the markets. But I think that would be a critical step in the right direction. As far as investment is concerned, obviously the PCC has set up a forum of CEOs of DFIs and includes now the PIC, which is a good thing. But I still don't really get a sense that there is a really coherent initiative by the public sector institutions to kind of create the kind of confidence that was being referred to by Judy within the private sector. I'm not sure we'll ever get the complete policy coherence that we really need at the political level. And so the public sector financial institutions need to actually step into that gap to provide the kind of certainty, investment climate, if I can call it that policy certainty might not be able to deliver. So yeah, I think those are my initial comments. I mean, I do agree with Judy that the pipeline is much bigger. The investment appetite is much bigger than the pipeline, and that to some extent is going to get unlocked by lifting the 100 megawatts ceiling. But I think some of us are somewhat surprised that there isn't more action happening in that space. And I'm not sure we really know exactly what the constraints are of the developers in that space. Greater transparency about that is required.
I would strongly agree, and I think greater transparency on both the planning, the execution, the policy matters, and as we move forward, the implementation will be key to ensuring that we have the right projects and the right access to funding. Thanks very much for that. We're now going to move on to the Treasury Perspective. So Vukile, over to you. Vukile Davidson is Treasury's Chief Director of Financial Sector Policy. And as I say, I think that Treasury must be smiling today with the wonderful positive sentiments from the commercial sector. And I do think we need to think smartly about how we unlock the funding potential. And I do think it's potential, the funding opportunity that exists within our decarbonisation journey, and how we can do that in a smart and aligned way. So Vukile, over to you.
Thanks so much, Joanne. And let me start by just maybe a quick disclaimer that the views and opinions I'll be talking to today are my own and don't necessarily represent the views of the National Treasury or the Minister or the government as a whole. So I thought I would, and I don't have a presentation, I thought I would just talk very generally about the broad policy framework, or at least our thinking around policy in relation to infrastructure finance, and in particular financing and sustainable energy. I should just mention that what I'll be talking about is in the narrow context of sort of financial sector policy, and doesn't include views on fiscal spending, which I think are in some ways well, they are a very critical part of the conversation, and in some ways more important, especially as it relates to facilitating a just transition. So on the financial sector policy side, we take a sort of our principal view in really thinking about this, and in how we've been and what we've initiated so far, in particular interventions around the sustainable finance paper that we released, and the 5 underlying sort of work areas is really informed by a sort of risk appreciation in the first instance. And what I mean by that is that we certainly recognize that the world needs to adjust and needs to take dramatic action if it's to meet the 2050 targets. And in facilitating that transition, the role of financial sector policy is to create an enabling environment for the creation of a critical mass of investment and assets that can transition the economy overall into a low carbon economy. We have both in mind outcomes for well, reducing overall the carbon intensity, but also trying to manage the risks associated with current depositors and investors. That of course closely relates to the work that's been happening inside Treasury from a financial sector policy, like I say, but also a tax policy perspective, where the principal policy lever that we have is the carbon tax, which represents a kind of stick. What we've focused on the financial sector policy side is creating the parallel carrot. So where businesses and firms will incur a liability for producing carbon under the carbon tax framework, we are on the financial sector policy side through the creation of a taxonomy, create the technical specifications for the assets that qualify as green, to shift those high carbon investments and high carbon business practices into a low carbon sort of operating environment. So the work that we're doing requires quite a bit of coordination and working towards some sort of policy coherence on both the domestic and international level. On the domestic level, as I've outlined, that really relates to aligning the work that we're doing in respect to the taxonomy, disclosures, and creating financing instruments to what is happening in areas like the carbon tax, working with key stakeholders. On the international side, and from what I've seen in the previous presentations, I think this is further underscores the importance of this, is create a coherent framework to allow capital to move from capital surplus economies to economies where they will need resources in addition to pure domestic resources to enable the transition. It's always been a key feature of the South African financing and funding market overall, that both domestic and international sources of fundings are required. And given the scale of the funding requirement, we anticipate that will be required for facilitating sustainable energy type investments as well, certainly. So what are we doing to try and create that international policy coherence? Through international fora, including the G20, but also international standard setting bodies, we are advocating very strongly for taxonomies to be linked through either an interoperability or mutual recognition framework. So what does that mean? That means that we should create a domestic taxonomy that is sufficiently credible and transparent and comparable to allow investors in the EU who are subject to their own taxonomy, or investors in other jurisdictions, the UK, China, etc., to be able to place reliance on our domestic taxonomy and reduce the compliance burden for those investors investing domestically. It also helps with some of the identified key funding sources in the two preceding presentations, including blended finance, where official finance, be it from the domestic development finance institutions or multilateral development banks like the World Bank, IFC, etc., who are subject to often external taxonomical frameworks to undertake investments domestically with that minimum compliance burden. So that gives a broad sketch of how we're thinking about it on the policy front. So far, we have developed a voluntary taxonomy working very closely with the private sector and various stakeholders within the private sector, but also with academics and think tanks and etc. The first green finance taxonomy is we're currently trying to embed that in the various other policy frameworks, but also working very closely with regulators to embed that into a regulatory framework. What we anticipate will happen first is that the regulators through the Prudential Authority and the Financial Sector Conduct Authority will initially, through a guidance note or some communication, indicate the areas where they believe mandatory taxonomical compliance as well as disclosure frameworks can be embedded into their regulatory instruments, and lay out a sort of roadmap for how we get there.
Hello.
Okay. Let me stop there.
No, you don't need to stop there. I think somebody came off mute. It wasn't me. So please continue. You've got about another, according to my calculations, you've got about another 3 minutes.
Okay. Well, I'll try and save you some time from the previous session, Joanne. So I'll wrap up now. In our journey to embedding it in the regulatory framework, we really see this as an important step to move away from a voluntary framework where some finance providers can take it or leave it, and completely embedding it in the investment approach and rules. Defining that environment through various hooks, including from Reg 28 more directly, but also collective investment schemes, asset management firms, as well as capital markets through listings requirements eventually, and as well on the Prudential side as embedding risk weights eventually to appropriately to assets that risk of transition. Let me stop there. I think I've said a huge amount, and I'll pass back to you if that's okay, Joanne.
Wonderful. Thanks so much, Vakile. And I think some very important points on the need for standardization on reporting. I think one of the big concerns in thinking about the scale of funding and referring to the 8.5 billion in the makeup, in thinking about the funding, it's almost less, the concessionality is important, but what is equally critical is understanding how we measure and monitor and report as a country. Because I do think that the more we fragment the way we actually measure and report and set standards, the more frameworks we align to, the greater the cost of funding and time being spent on compliance as opposed to creating impact. So I really think that it's some critical work that's been done within the green taxonomy. And in the financial markets, I see Shamila has joined from the JSE. So when we close up with Chantal, we'll move on to Shamila. I'll just give you a heads up now, Shamila, to just get some perspective from the JSE. And I know that that SEIC is also doing some quite important work in this space. And it's a really important space for us to ensure we drive consistency and alignment. Moving on, we now are moving on to Chantal, who is working with Daniel Manele on the Just Energy Transition Partnership. So Chantal, you would have seen the extensive questions on the 8.5. So what can you share with us today? Thanks.
Thank you, Joanne, and thank you for the invitation.
Chantal, you are very faint.
You can't hear me? Okay, I'm gonna put headphones on.
Okay, we'll just give Chantal a minute to adjust. Chantal, are you
better? Can you hear me?
Yes, that's much better. Yes, thank you.
Okay, great. It's the baptism of a new computer, Joanne. So still getting used to how it works.
Well, you're very audible now. Thank you.
Perfect, great. Well, thank you to the PCC for the invitation and also for the intro, Joanne. So what can I share today? Perhaps first, I wanted to share a personal reflection on transition and financing transitions that might it certainly helps me try and understand what do we want finance to do during this, what some call a messy middle phase. So the way I see it, there are almost 3 tracks of issues that we need the finance community to respond to. When I say community, I mean both public and private, and the whole array of blended options that might exist, including philanthropy support. And the first part is a fairly disruptive way of unraveling our dependency on fossil fuel in all the different ways in which we are dependent on that. So the decommissioning exit, responsible exit, which is both an issue for public sector but also for private sector, having to decarbonize their own balance sheets and loan books. And then on the other end of the spectrum, there's an aspect of investing in the clean side, so the creation of cleaner energy sources, cleaner energy or cleaner production and consumption facilities. And what strikes me in terms of how funding is flowing at the minute, it's actually quite overweight on the creating the new. And it's harder to find funding that helps to disrupt and responsibly exit, the system that we already embedded in. So I see financing the transition, or has some package the two together, transition finance, as being that bridge between those two places, creating both a way of responsible exit, but also bringing in the complementary critical infrastructures in that middle. And it's a really essential component of finance but to get one's head around the fact that finance has to both disrupt and create at the same time, whilst keeping everything stable, is actually quite a heady type of challenge. So for me, the Just Energy Transition Partnership is a really important and pivotal partnership. And the key question the task team is grappling with around the Just Energy Transition Partnership is, how do you utilize international climate finance effectively in the context of South Africa's journey of both decommissioning, exiting, creating something new, and doing it in a way that recognizes and beyond that responds to the social, economic, and environmental disruptions that happen in the midst of all of that? The partnership has got obviously many distinguishing features, but those that stand out are, it's the first time that under the COP since the Paris Agreement, there's been an acknowledgement that this type of funding is needed by developing countries like South Africa. And it's also the first time that the justice component has been elevated as a key essential component of the partnership. So the offers that have come through from the 5 countries is in recognition of this broader vision of South Africa based on the updated NDCs, contributing to how we embark on this path, helping us to go further, helping us to go faster. And we say those words because it's in recognition of, I haven't heard all of the prior presentations, but it's quite clear and something we can be so proud of, that at a national level, despite all of the sometimes moaning and groaning about fragmentation that we have in our space, there's a lot of groundwork that's been laid to enable us to pull together and at least understand and bring together past experiences to be able to contribute as a nation financially as well into the just transition. So some early work by some other colleagues reflects, a substantive pool of interest. I think Mark might have made a comment earlier about almost an oversupply of capital in some sense, that the resources are there. Maybe there's a shortage of the pipeline. So in that sense, the 8.5 billion is not going to be enough for what we need to get done, but it is recognized as a contribution. There is a instrument profile that has been proposed by the 5 countries based on their own assessments. And that's something that we're actively engaging with them on to make it more demonstrative of the country needs and be more responsive to the country need. There is also work, as I'm sure by now most are aware, that we've developed the first draft of an investment plan. And in that investment plan are the 3 priority areas, which is in the political declaration: energy, new electric vehicles, as well as green hydrogen, with the justice component embedded in those significantly. So we've done there's been a lot of work happening, I guess, below the radar, which hasn't broke surface on some levels, but the investment plan has started breaking surface, giving the sense that the working groups that have started in the last 2 weeks and consultations that have also been ongoing. So there's a lot to get one's head around in this, and I think that it's important to have a key question that drives us, in the sense of, what can international climate finance do differently? What risks can they absorb? Is this different from regular climate finance and different from development finance? So those are ways in which, from the task team level, there's boundaries with the developed country partners that we are trying to push to meet South Africa's needs more precisely. It's a close working relationship with Treasury to understand our fiscal realities and to make sure that the ultimate package that we land on reflects as close as we can our funding needs, recognizing that we actually have to mobilize a whole lot more. Joanne, perhaps I stop there and I see some questions coming up, and perhaps there are other questions you want to prompt me on as well, just given that I wasn't in the whole conversation.
Thanks so much, Untitled. I think there was a good summary of where we are and what it is. And I think, just to pick up on the last question, I don't want to spend too much time reading while other people talk, but I don't think it's dependence on the Great North. It really is a partnership to ensure that the Great North does enable the decarbonisation of our economy. The opportunity that we have in decarbonising is far greater than just the South African economic and environmental opportunity. I do think that there's significant opportunity to grow and reindustrialize our economy. So I think that there's value in foreign funding coming in, foreign partnerships, ensuring that foreign policy is enabling to our economic opportunities. So there's a very good reason to ensure that we manage and engage our partners globally, because decarbonization is about the whole globe. It's not only about us. And as I said earlier, it's not only about public sector. So I mean, this really is, I think, the greatest collaboration of our time. And we do need to ensure it. So what I do agree is this is our transition. And Chantal, our language, please remind me, I've just forgotten. We keep saying it's please remind me. We talk about it being our deal. Mm-hmm.
You speaking about the risk sharing as opposed to the de-risking language?
So it's our transaction. So this is our investment plan. This is our opportunity.
Yeah.
There's a great slogan we have.
Yeah, I'm not sure if it's the same one you're thinking of, because we have a few in the TOS team. But then one important thing to remember is, and that's the message we've sent to the international partners as well, is that it's our investment plan to approve. So whether there are parts in there that they don't like, that they don't feel that they can fund, it doesn't mean that we'll take those out, because we are trying to develop an investment plan that's critical for all of the parts that make sense for the country in the at least in the next 3-5 years, which is the line of sight based on data, based on our policy environment. So we've been quite cheeky. I think that's maybe where Joanne is getting to, quite cheeky in saying our plan to approve, yours to endorse. If you don't like it, well, fund the parts you like. We'll get money for the rest from wherever we have to get that. So it's quite, I mean, it's not that one wants to look a gift horse in the mouth in any way, but there's also geopolitical issues as well that can affect how the funding actually ultimately reaches us. I saw there was a question about guarantees and whether it's real money or not. I think some would argue guarantees are real money if they actually do help, advance, say, an investment proposition, if they enhance the credit quality of a particular issuer, for example. So there are lots of really useful instruments that are all on the table that are being considered. The allocation and the levels across the instruments might not immediately match where we are heading to, but that is part of the negotiation process. And it's also part of the discovery process of the investment plan needs in itself, which the consultations are also throwing out. And also trying to find a way of, so chatting to some colleagues yesterday, it might be that private sector is all lined up to invest on the clean energy spectrum and do many things that are lined up on the industrialization spectrum, but they need 20% of something else to be unlocked up front. And those are sort of the tipping points that we are trying to find through this investment plan, through the consultations, because it's the best use of that funding, which is coming through on fairly concessional terms in certain, and a lot of goodwill, to be honest, from the partners. There's ways in which we're testing them, but there is a fundamental goodwill that they want to do this with South Africa. So we do have a magic moment, in a sense, to, as Joanne's saying, this joint partnership, but it's also, and we have a private sector that is very much attuned to wanting to do this as well. The one thing that one mustn't forget, and that's the part that really I don't think we've bottomed yet, is the aspect around the social. The justice component, not to be a tag on, not to be something fundamental, and making sure there's appropriate safety nets in place, so that there's immediate support and relief for some communities. So there's a lot on the task team's shoulders. I mean, Joanne, Deepak on the call as well. I don't know who the other task team members are that might be on the call, but there's a lot that we're grappling with, but there's a lot of progress we've made. We've thought through financing principles that are reflective and supportive of a vision for climate finance that developing countries have been fighting for. Whether we land there or not, at least we're trying. We're also looking at prioritization criteria or guidelines, at least, for the kind of interventions that we want to bring in. And again, all of these things will come out in the wash when we actually, hit the ground with the implementation. But there really is a lot of work going on to make sure that whatever it is real, and it's not just a lip service to something that you know, I think I'm not going to quote the trustee member that said it, but they know who they are. We're not going to go to the COP and make our partners look good. If we go to the COP and present what we're going to present, it's going to be authentic and substantive. Yeah. Thanks,
Completely
Joanne.
agreed. And I think that there's already value that's flowed from the 8.5 billion in the quality of conversations that have actually started over the last year and the level of planning that has actually been enabled and the progress that we're seeing in that space. And I mean, one of my, so the saying I was thinking about is by South Africa for South Africa. So
Yes.
it very much is a South African plan for South Africa. And I really do think that the decarbonization pathway is the what and the just is the how. And we do need to ensure that we plan for that how, so we do get a very just outcome and impactful outcome. So Chantal, thank you very much. I'm now going to ask Shamila. I think Shamila has been given speaking rights. So Shamila, over to you and your thoughts on funding. Thank you.
Thanks, Joanne, and also apologies that I have missed a lot of the conversation. So I'm going to go in with a few thoughts on instruments that we do have in the market available. So JSE, obviously considering the public market perspective and what we can do to help create this enabling environments to reallocate capital and to really look at more green and transition financing. I'm going to focus on two elements very quickly, Joanne. The first one is the element.
Shamila, I think we've lost Shamila.
Sorry, I see that my rights changed panelist, so I'm now visible as well. Joanne, yes, hi to everybody. Yeah, so the two focus areas I think I want to make are really on the instrument side as well as then the disclosure side. So it's overarchingly about how do we create an enabling environment, right, for finances to flow, for better disclosures and the like. So the two interventions, I think the first one is going to be on the capital raising side. We already have the ability for companies or whichever issuers to list green bonds, social bonds, and sustainability bonds, as well as sustainability linked bonds. And then so sustainability linked bonds and transition bonds went live in April this year. So we're probably one of the leaders globally to have taken that bold step to actually have a transition segment. And that is really for looking at those, the capital raises that are enabling the transition from brown to green. And that is probably, something that is very useful for our circumstances. And so we probably took a bit of a bold step to enable that. So that is available on the JSE already. It follows the principles that are in the International Capital Markets Association Just Transition Handbook, and really talks about, to be able to label yourself there, you have to have a credible plan. That plan needs to be aligned with something, it mentions having a Paris-aligned pathway, for example. So it's not just a matter of saying, I can go onto this segment and if it's not green, I can put it there. There are criteria that try to ensure the integrity of what is being raised and that it's clear for the investor to see what that money is enabling in relation to a transition pathway. And then the green bonds, of course, are very well known globally. So that is already there. And that segment of green bonds were available from in the regulated environment from July 2017 already. At this point, I think we've had just over $1 billion in issuances on the green segment itself. So that's excluding social bonds and sustainability bonds, which is quite significant. Although yes, it's a small fraction of the overall bond market, but I think very encouraging, and also encouraging to see now the interest that has built up in that space. The beauty, of course, of having an instrument listed on the JSE is that it helps and makes it much easier to access institutional investment and for institutional money to then invest in that. And that's our pension funds, insurance funds, and the like, to use their money to actually enable that transition in the country. So that's on the instrument side, where we have those key ones at the moment and where we're seeing really good interest in that pipeline. The second is more about the environment, right? And this is predominantly the disclosure environment. Ours is a globally exposed market. We're already seeing that investors are asking questions. They're wanting certain levels of disclosure, even in the absence of mandatory requirements in our own environment. And, Vukile spoke before, so he's talking about where that goes. So what we have, for example, issued in June this year is disclosure guidance. So 2 sets, sustainability disclosure guidance, which is an overarching disclosure guidance that's talking to the E, the S, and the G, and the themes under that, which, for example, include climate change and have brought in certain elements on indicators related to transition, because we felt that's how we needed to make it context relevant for South Africa, and you can't do this without talking about just transition. The second area there is then the climate change disclosure guidance, which is a double click, effectively a more detailed thematic guidance on climate change that follows the Task Force for Financially Related Climate Disclosures. And that really is is answering to that need to say companies are needing to start disclose on this. How can we assist them in doing that? And what is kind of the global, I guess, de facto standard for considering this? We've brought in local context. We've tried to bring in the principles that I think have existed in this economy for a long time. I don't want to wade into the debate on materiality here, but for example, that is one of the key issues right now with standard setting and reporting and disclosure frameworks globally. So we've taken a stance on that, and we've suggested double materiality is the way to go. But what we've also tried to do is make it easier for participants in the market. And remember, this guidance, while it's really, our remit is public companies, the fact is it could be used by any entity if they wanted to think about how to start disclosing and to make sense of a lot of the noise that's happening on disclosure, start bringing meaningful disclosure there, because the money is already asking for that. But of course, the bigger need is that you need to start assessing your risks. You need to understand where you fit in and at least start asking these questions of your business. So those are the main areas. And I think finally, before I forget, the reflection on Vukile's point around taxonomy. As it stands, the green bond segment, or the green segment on the JSE, which is part of the sustainability segment, automatically now could allow for a user to actually tag their assets or to use the taxonomy as the basis for their claim, for substantiating their claim of green in terms of that. When we set up the green bond framework for the JSE and the listings rules, we were deliberately flexible in allowing a level of flexibility for issuers to decide what framework they wanted to base their claim of green against. So right now, there isn't, for example, it's not as prescriptive as saying you need to follow CBI, the Climate Bonds Initiative. It actually allows that flexibility, which again, we feel is useful for allowing national circumstances to be brought in there. Of course, you need an external reviewer to make sure that what you're saying stacks up with something that is considered globally acceptable. And in this case, of course, if we have the taxonomy, that makes that tagging a lot easier for a number of issues. I'm going to leave it there, Joanne, and hope that gives some sense of what the markets are doing, both from a disclosure perspective to enable that understanding and practices and changes, and then as well the reallocation of capital.
Jamila, thank you so much. I think that was a very useful perspective and building off the conversation from Vukile. So thank you very much. Apologies, my dog's going mad in the background. It's the only downside of working from home. We have a couple of commissioners on the line. So I'm going to ask Louise or Lebogang, is there anything that you would like to add from your perspective? Thanks. Thanks, Louise. I know you to always have an opinion, so please, we'd love to hear your perspective.
No, I'm sitting here quietly learning, Joanne. Listen, what I did think was very interesting, I think it was in Mark's presentation, there was a sort of, the types of areas of investment needed, and then an arrow going down saying, the types of capital that is needed. And I'm a bit, and then down at the bottom is the sort of just transition elements, which would be the social security stuff and the upskilling and so on. And matching that on the bottom that's where the grant and public finance goes. And I understand very well, having come out of the private sector myself, that private capital goes where there is a tolerable return on investment. But I think we should not necessarily say that, only grant and government money should be used for the just transition elements. I think we need to figure out what is the responsibility of private capital in that sphere as well. And I think that the fact that right at the top of the down arrow was private capital only for renewable energy, it's also saying that, are we not investing as a state in our own electricity supply? So I'm not sure whether that was meant to correlate, Mark. Maybe it wasn't meant to correlate in that way. And I know it's tendential. It's not sort of, a direct line from left to right. But yeah, that was something I did remark on for myself.
And I do think that there's significant opportunities for all types of blended finance across that entire value chain. And we do need to find a way of leveraging private and commercial capital on some of the just transition elements, because I do believe, as much as some of them are very social and will be grant on a long-term basis, even those could be funded out of CSI and ESD schemes that corporates run, but there are a lot of those that could be
and skills levies. Use your skills levies funds on this. Yeah,
it goes back to the comment earlier from Judy. There's not a shortage of capital. There's actually a shortage of linking the right capital to the right opportunities. And I do think we need to look at all of our compliance capital in the economy and how do we reapply that compliance capital to actually create impact through the transition. I see Lebogang, you had your hand up. I did call on you. So Lebogang, over to you and then to Catherine. Thanks.
Thanks. I didn't expect to actually say something because, like Louise, I was actually sitting and listening. This has been a very, very informative session. So, in fact, in the response that you've given, you've kind of raised a potential question that I would have had, and it goes back to what Louise is talking about. You know, the difference between the public and the private investments, and how we're going to leverage both in order to finance, especially the social aspects of the just transition. I think I'm not too sure what work is happening around and how much we've actually taken into cognizance the ability to kind of cost the social aspect of the just transition, and it's going to be a substantial amount of investment. And I know a private investment will want to chase where there is a return on investment, but it would be worthwhile to do the work. And I'm not too sure if corporate social responsibility would be enough, but we definitely have to do some of the work to see, you know, how much would be needed, because I think that the transition is going to be substantial and the social aspect of it is going to be even more substantial. So I think, yeah, that would be it in terms of an input from my side. Thank you.
Very much agreed. And I think on the work that's being done, as much as a lot of work is being done, I think not enough is being done. And it again comes down to alignment of objectives, funding, and projects, because I do think the more we can do on a collaborative regional basis, the more capital will actually be for impact. So to give an example, the Impact Catalyst that IDC is a partner of, what they found is when they started engaging corporates in the areas of their focus, they found that they were always spending significant, or had been spending, significant amount of capital for the last 2 decades on exactly the same things, and no impact had been achieved. So how do we learn the lessons of compliance of the last 20 years in order to ensure that we drive collaboration and impact in the next 2 decades? Catherine, over to you, and then Mark.
Thank you, Joanne. I think I'm going to disagree with 2 people I agree with most of the time. And fortunately, Mark, as chairman of the DBSA board, allows us to differ from him occasionally. So the one thing is that Mark mentioned that, you know, we should move further down the value chain in terms of transmission for DFI specifically, and perhaps start moving away from renewables. And Mark, if I'm paraphrasing it incorrectly, you can gladly correct me. But I think that because of the energy crisis, I think there's still a substantial role for DFIs to play in that space, even in the 100 megawatt space. If the off-taker are municipalities, you know, counterparties that aren't, you know, commercially or as creditworthy as a corporate entity that we used to. The other thing is also in terms of and how you fund transmission projects is very much how Judy described. But I think where I differ from Judy perhaps is, and maybe we could look at this, and maybe she meant in different context, but I think renewables are commoditized. And I honestly think if it wasn't for Eskom's balance sheet status and our precarious view of our utility in terms of being a credit-worthy counterparty without government support, we probably at this stage, 12 years later, would have started looking at it as more of a commoditized asset. And if you were to fund under 100 megawatts a normal corporate entity, you would have assessed it as you would in any other commercial deal. And you don't always ask for a guarantee. You look at the cash flows of the off-taker, and you look at the cash flows of the project, and you take a view on that. And then you decide whether you need a guarantee or not, and whether it's a part guarantee or, as Judy mentioned, an option, a put option to buy. But I honestly think I think renewable energy, it's easy bread and butter for banks. And that's why we tend to lean to it. And because there isn't enough bankable pipeline in the market, an investment in project prep in the market for investable pipeline, that we tend to default to renewable energy. But we know a lot about it now to give ourselves enough comfort to say, do we actually need the level of guarantees we still need in that space? And I believe we do, based on the counterparty risk, and it's not always going to be Eskom. Thanks, Judy. Joanne, thanks, Joanne.
Thanks, Catherine. Thanks for those words. Mark?
Yeah, I mean, I think Catherine makes a great point on guarantees. I would agree with that. I hear what she's saying about staying in the IPP space until the off-taker issue is resolved. I was really referring to how we build the financial models that can allow us to go take the grid construction process to scale. And I'm not sure, there's various suggestions and discussions in the market about how to do that, but I'm not really seeing that coming together. So that's really what I was referring to. Just coming to Louise's point, I think it would be a mistake to only focus on the funding for just transition as the only area where workers and communities benefit. As was reflected in Judy's presentation, but in lots of other research, the construction of renewables also generates significant jobs. The operations and maintenance, the long multi-year build program that we're looking at for the next 20, 30 years in terms of the job impacts of that. If the SA Renewable Energy Master Plan frames things in the right way, upstream industrialization becomes probably the biggest industrial program we will have had since '94 if we get it right. And that's all going to have very, very positive impacts on our biggest challenges in the socioeconomic sphere. We do, however, need to recognize that there is a place for the kinds of investments in capacity. So DBSA has learned a lot through its D-Labs program. And basically that is premised on an assumption that money follows capacity. And where there isn't capacity, that's where you're going to find a lot of inequality and poverty. How does one invest in building capacity? And that's what the D-Labs are. So the Jabulani D-Lab, the budget for that was 50 million rand. 30 million has been spent in order to create a gigantic institutional capacity for mobilizing all sorts of capacities within the local area and beyond that will completely transform that area over the next decade. That's the kind of thinking that we need, not small-scale investments, but large-scale investment. And 10 billion over the next 20 years. I mean, 10 billion is bigger than the size of the book of DBSA and IDC. You know, it's a lot of money to spend. I think we'll find it quite difficult to do that. Thanks.
Completely agreed. And I think it's more than just the direct renewable energy build. It's the value chains and the industrialization opportunities from there that really is going to create the the justice in the transition, because once we have this very long-term infrastructure build and maintenance plan over the next 2 decades, the opportunities for localization and globally competitive capacity to be built to support not just our transition, but also that of the continent, and supporting green industries in our neighbors, I think presents an incredible job, social, industrial, tax, economic opportunity for us. So it's also integrated, and the more we do this in alignment, I think the greater the opportunity to achieve a real impact. Catherine, you did add some points on Mark and Judy's comments. Is there anything you would like to add from a just transition finance or development finance perspective with your breadth of experience? Catherine Kaufman, that is.
Oh, I see. Okay, yes, Joanne, I thought you were talking about the smarter Catherine. So yeah, I must say my experience at the DBSA, which is actually have not been that long, so the transition from commercial to DFI, what I've learned is that DFIs are very well positioned to access the type of funding that actually allows us to really make progress on the just part of just transition through various ways, through concessional funding, through accreditation to climate finance agencies, etc. And these accreditations, Joanne, as you know, is not owned by the DBSA per se. It's usually regional, and what it's for is to allow investors, other banks that have projects that will allow some sort of climate risk mitigation to happen, or some sort of intervention from an adaptation perspective to happen in those projects, to access concessional funding, really low interest rates, long tenors, to permit these blended finance structures that Louise was speaking about, where you can engage both private and public sector in the same project to unlock bankability, because you're providing that first loss grant funding that's available that Judy spoke about earlier into the projects to make them bankable. So I think also because private sector tends to be a little bit more risk averse in terms of some of the risk they take, especially if it's developmental, that early stage stuff, their development financing has played quite a crucial role. Even if you look at the programs that are coming out of the work that the DBSA, and this is not a DBSA punting session, but just to demonstrate some of the work that's come out of what DBSA is doing in the programmatic space was first about the DBSA doing a pilot and taking its risk on it themselves. And then once they've gotten the market comfortable that it can work, making it something more of a program. And those type of activities where you're market makers is quite an important catalyzation tool for private sector investment. So I think that definitely have a significant role to play in terms of that early stage development, but also from a policy perspective. The gentleman from Treasury mentioned, he said it's in his personal capacity. However, I noted that from a Treasury perspective, that's quite an important lever for creating a carbon market, because once you do that, you provide people with alternatives, even for funding, having an exchange market for transitioning, where you provide access to carbon incentives, carbon tax incentives, where you penalize people for not behaving appropriately in terms of the type of investments they do, but you also reward them for when they do. And so those kind of interventions where we can talk to policymakers and we can help with legislation, because we have a whole international community that we also tap into, is where I think DFIs can play a significant role. And we're not doing it because we're good people also. We're also doing it because at the end of the day, most development institutions, first of all, most of us, 197 banks signed up to the UNEP Finance Initiative Principles for Responsible Banking. And as a consequence of that, we've got certain commitments and responsibilities. but also the DBSA itself, and I'm sure the IDC and the rest, we go into market to raise funding, to fund all our development projects. And we go into a market that's very much aligned with transition financing. We've also in some way or another, either through stakeholder engagement, through their shareholders, even the employees have signed up to a net zero 2050. And so they care about where we put our money. So we're very much incentivized to do the right thing, but to do it in a way, obviously, that's transitioning, that takes everybody along.
Thanks, Catherine. I think very important points. And when you talk to some of the shared value concepts, and shared value has become also a bit of a compliance approach, but when done in its purest form, it really is about creating sustainable programs that are good for private sector and for society and for the environment. So it really is finding those pilots and programs that enable us to do things on mass scale, because it is one thing that we've seen. I've just recently been involved in a gender financing assessment. And when you start looking at the gender finance solutions that are in place, everyone can talk to the great successes they've had, but a lot of that has been more in design than in scalable impact. So it really is not just the design, it is about the piloting, ensuring we learn the lessons, get it right, and then doing it in a way that impacts millions of people as opposed to hundreds of people. So quite a task we have ahead of us. Mark mentions the community ownership models, and I do think that that is something that's quite key to be looked at. I mean, how do we really ensure that these communities do have access to some of these significant dividend and revenue potentials from these solar and wind installations and the green economy opportunities that are presenting themselves? So I think that that's a very important model to look at as to how do we get that right in a cost-effective and, again, impactful way. And then over to the other Catherine, and apologies, Catherine, Catherine Stodolka, apologies if I get your surname wrong, but I'm not sure if you would like to add some perspectives. Thanks.
Joanne, thank you so much. And certainly not the smarter Catherine as the real smarter Catherine mentioned earlier, but possibly the more frustrated Catherine at the moment. And I think that is partly something we've seen in the chat today as well. I think John has mentioned a couple of times that, you know, these big climate finance pledges are PR and that they're not actually sort of designed to actually get funding where it's needed most. And so the comment that I just wanted to make is that the catalytic capital that we're looking at, the public funding from donors, the philanthropic funding that's being pledged, needs to be fit for purpose and it needs to be demand driven. The first point about being fit for purpose, the most basic interpretation of that is that money from donors shouldn't go where the private sector could invest. And the graph that Mark showed is sort of designed to reinforce that. You know, different types of money has different mandates. And so I agree wholeheartedly with the range of ways that the private sector, both corporates and investors, could be embedding a just transition, embedding social outcomes and accelerating and supporting, particularly in the reskilling and upskilling agenda, because it's in their interest to have a workforce that can participate in the green industrialized economy. But when we look at funding, which often ends up coming from donor governments, you will see that it's crowding out private investment, and so it's not being used at its highest and most catalytic purpose. And that's a big issue, and I think that's what conversations like this and the important work of the task team and the PCC continue to do. It is bringing transparency to the types of instruments. We've talked a lot about guarantees, but it's also saying it's not good enough for very special, rare, scarce funding, which is meant to be for high impact development. It's meant to be for the just transition, to be funding stuff that you could have private banks or commercial banks doing. That's not its purpose. And it's really important when we think about these deals and these pledges that that type of money is being used where it's most needed. And I agree with the comment earlier from Chantal that often the social piece of that gets lost because it can be smaller ticket sizes or more complicated to deploy. The last thing I just wanted to say when we talk about this kind of catalytic scarce capital being fit for purpose and demand driven, it is that I think there's a real shift in these discussions, and I'm super grateful for it because you often don't see this level of engagement, but the shift in the development finance system itself. At the moment, big decisions are made in DC, or they're made in London, or they're made in Paris, very much with the donors, instruments, interests, and structures in mind. And it is critical that the comments from Chantal and yourself, Joanne, about this is for South Africa, by South Africa, is reinforced, and also it builds solidarity with other JETP countries and other countries who are sort of quote unquote recipients of climate finance. And that's what we're at the Blended Finance Task Force trying to work on very actively with Mark Swilling and others is shifting decision-making power, because if you get something that's not fit for purpose and not demand driven, how can that funding get deployed? How can it go to where it's most needed? And then, how do we use it to make the markets that we know South Africa is investable. We know the renewable space can be a massive boom. We know that there's a huge green hydrogen opportunity, but that requires community support and rehabilitation, that requires funding for decommissioning, and that requires some of those social transition costs to be taken by capital that is meant for those maybe non-returnable investments, but investments nonetheless. Thank you so much for having me, and I will pass the mic back over to you.
Great, thank you so much. Some, I think, very important points for consideration. So thank you very much for bringing that perspective. I'm now going to open up to the audience and just see if there's anything that anyone would like to share, any perspectives that people would like to bring. Deepak, are people able to raise their hands and speak from the audience, or should we address questions in the chat? Apologies.
I think we should check with Steve and the main host whether hands can be raised.
Yeah, I mean, people are very welcome to give their perspectives from the audience. If you raise your hand, we'll give you the right to speak. But obviously, if there are no comments from the audience, we can start to wrap up. Thank you.
Great. Thanks so much, Steve. Any comments from the audience? I don't see any hands.
Richard Worthington.
Okay, thank you. I don't see that hand. Richard, over to you.
Thanks very much. Just a fairly small matter, but the 24 billion that is included in the list for the accelerated retirement of coal-fired power plants, I'm wondering if that is, I mean, it's part of the overall cost to the country of decarbonisation, but seeing it appearing in those lists with other kind of expenditures, this is about money that Eskom is anticipated not to earn from the coal-fired power plants. I'm wondering if this is being considered within this first tranche of 8.5 billion, and whether it's imagined that this will actually be cash transfers, or if it's really there just for the point, making the point that this is a real cost to our economy. Thanks.
Venturing off piste, I would say that as the 8.5 billion gets looked at with respect to what the early allocations should look like, clearly Eskom's decommissioning and decarbonisation processes are front and centre, both for the carbon decarbonisation trajectory, as well as in its repurposing those sites to be renewable primary energy generated. So I'm not in a position to actually say whether one or other component of the 8.5 billion is going to be earmarked for this cost. But I think people on the call will understand that the decommissioning is a really critical part of our decarbonization, repurposing, and then the just transition elements that accompany the spatial effects of that decommissioning and repurposing.
Deepak, thanks so much. I lost complete control of my computer and couldn't unmute myself. So thank you for stepping in there. Really appreciate that. So I hope that that addresses your question, Richard, and I think that there will be a lot more detail and information on that as both the climate deal and the Eskom plans progress. Richard Halsey.
Oh, thank you. I just wanted to raise a question which I did briefly mention in the chat, and this is not my opinion. There are a lot of groups, analysts, civil society organizations, and that monitoring the JETP, and there is a growing concern around what is called the justice elements or the justice components, that they are not being addressed enough, or that appropriate people have not been involved from the outset. And again, this is not just my opinion, it's reflecting those of others. So just if there's any sort of thoughts on that, because the publicly available information doesn't show how these justice elements so far have been meaningfully included in the design. Thank you.
Thanks very much. And I mean, there is a focus in one of the sections of the investment plan on the justice element. I'm not sure if Jesse's on the line, or if Deepak, you want to give some context of what the PCC has done on the just transition document that was presented to the President. Thanks.
Correct. Perhaps Crispian also in his rounding up towards the end can talk about this, but the PCC has been very clear that our transition has to have embedded justice, all three types of justice components embedded in our overall transition. With respect to the JETP, I think we must differentiate between the JETP's interest in the decarbonization outcomes, but we as both the PCFTT and the PCC are insistent that in those spaces where in particular decommissioning, repurposing happens, that's local spatial issues, whether they be livelihoods, value chains, as well as small and medium-sized enterprise development, as well as a newly emergent body of thinking with respect to much more decentralized community-based ownership, in particular of the renewable energy projects, is beginning to take root. And I can give all colleagues the assurance that the PCC will ensure that in the overall just energy transition, all three forms of justice are clearly embedded. One must bear in mind that there's another component of justice, and that is with respect to adaptation and climate resiliency. And again, here the PCC is going to ensure that we begin a body of work that looks at pathways for socioeconomic development, as well as adaptation and resiliency strengthening in the work or the pathways that we go forward. We must understand, though, that with respect to just the straight decarbonization program, which relates to industrial transitioning, we will have deeply embedded justice components related to that piece of work.
Thanks. And I'm glad you mentioned the industrial side as well, because there is the transition opportunity and requirement, or rather should I say the just opportunity and requirement is far broader than the coal value chain. So it really is to ensure that that is embedded in all three of the decarbonization pathways, and more broadly in all that we do within building a green economy. Are there any, I don't see any other hands. I think maybe I'll then just move into a brief wrap up before I hand over to Deepak and to Crispian, if there's any last words from our chairperson, or not our chairperson, our secretariat, our executive. So maybe just to wrap up, I mean, we've set the context of the the various investment areas within electricity and energy decarbonization that is necessary, from the early retirement through some of the new decarbonization pathways, the renewable energy and storage. We've talked through the funding mechanisms and opportunities and the different stakeholders that would be optimally placed to fund the various elements of the decarbonization, those that are highly commercial, well-established, mature technologies, being very much that of the commercial space, with the development banks playing a stronger de-risking and enablement and catalyzing role, and partners, philanthropy and foreign donor funds being really used to leverage and unlock some of the additional opportunities that present themselves. We've talked to measurement and monitoring and consistency and coordination as being quite key to ensure that we manage both the cost of compliance as well as the transparency, to ensure that we can both deliver on the plans and attract and report on the funding and impact achieved. The greater the transparency and consistency with global standards in our reporting, the easier it will be for us to access some of those international funds, and also demonstrate South Africa to be a high quality investment destination for green funds through the growth of our transparency and maturity in reporting. We've talked through the commercial opportunities for funding and how we can leverage the institutional market locally and do that in a way that minimizes the burden on the fiscus, recognizing as well Catherine's comments that we shouldn't be limiting the opportunities to the credit quality of the counterpart that is currently Eskom. We should really be looking at how we fund transactions in the most effective manner, recognize the maturity of the schemes that, for example, REAP. Then the climate deal, just really, I think there's a very strong sentiment that we need to ensure that the climate deal is for South Africa and is in our best interests, that the funds are enabling and catalytic, and that we really don't allow ourselves to be influenced to do what isn't right for the country because funds are available. The funds are only valuable if they actually enable what is our priority to deliver on. Very strong sentiment on the justice component, really ensuring that what we do explicitly and specifically includes the justice element, that we ensure that we have fundable opportunities and commercial opportunities or sustainable opportunities for funding in the justice space, so that we ensure no man is left behind and no woman is left behind and no community as we transition to a clean and green economy. So I really thank you for your time today. It's been a very interesting engagement, lots of wonderful perspectives. Thank you for the presentations. And Deepak, over to you for the further wrap-up. Thank you.
Thank you so much, Joanne, and thank you very much for steering this ship so ably and effectively and democratically. All that is left for me is to thank the speakers who presented, to also thank the sector experts who at very short notice made themselves available to share some of their perspectives. I do want to say that this is an ongoing conversation, and while there might be many debates which must be encouraged to continue, what remains is for us to find a consensual pathway or pathways to ensure that within the scope of our own involvement, we do a couple of things. Where we have access to making funding decisions, we make those funding decisions in a way that is aligned to our decarbonization and just transition outcomes. Where we have regulatory or policy impact, we must apply ourselves to ensuring that the environment is conducive to maximizing, both with respect to mobilizing and then scaling up, access to various types of financing. It was very heartening to know that some early steps are already underway in anticipation, and that South Africa does possess the domestic depth and breadth to make a huge contribution from within our own resource base towards our own just transition. Finally, I think to the points that both Chantal as well as Catherine Stodulka made, we must hold the international community accountable for the promises that they make in the international sphere, and forge healthy as well as partnership basis on which to work together going forward. On that note, I would also like to invite everyone on this dialogue to be on the lookout for future dialogues. You are on our mailing list now. Please make a contribution as well as attend. With those words, I will hand over to our Executive Director, Dr. Crispian Olver, to do the roundup and wrap up this session. Thank you so very much, everyone.
Thank you, Deepak, and thank you, Joanne, for so ably chairing the session. There's not much left for me to say. I mean, Joanne summarized our discussions today, which I have to say I found extremely educational and interesting. I really appreciated all the questions and comments. And it's clear from what you're saying, and just to reiterate what some of my colleagues have said, the just transition, the justice parts of this transition are not an afterthought or a nice to have add-on. They are integral to the way that we think about the transition. It is people's development at the end of the day that has to guide our decision making. And we cannot embark on a transition process that is going to penalize those that have contributed the least to the problem. So, I think all of the points are well made. The just elements have to be an integral part of our investment plan. I understand that the PCFTT and the team that is working on this JET-P have taken that message to heart, and I think people will be very pleasantly surprised when you see the investment plan that does come out. Deepak's already invited you to participate in our future dialogues. So just to say that the next one is going to be really interesting. It's going to obviously build on the discussions today, and we're going to be looking at industry structure. So, how do we envisage the energy industry of the future to be structured, and what are the governance arrangements that we need, including, how do we conduct energy planning in the context of a very decentralized and more competitive electricity grid. So that's taking place on the 15th of September. I've put the link in the chat. And then on the 6th of October, we're getting onto jobs and the energy transition. So, what are the different scenarios for job creation, and what are the modeling initiatives show us? What do we have to do to make sure that those jobs and investments materialize? And how do we concentrate our efforts on the areas that are going to be impacted by the coal phase out? So that's on the 6th of October. And then the last in this dialogue series is on the 27th of October, so just before COP27. And that's going to be looking in particular at what is the pace of the coal closure. So, what are the decommissioning plans from Eskom in terms of the power stations? What's going to happen more broadly to the coal market, and how do we envisage that impacting on the pace of closure of coal mines? And all of that will then have set us up for the broader stakeholder dialogue that we'll be convening after COP27 on the energy transition and the preparation of the recommendations that we're going to be making. So as we've said before, the Commission has set its mind to making recommendations to government on the energy mix, the energy planning system, and the overall energy transition within the context of the just transition. And we're anticipating that report to be coming through the system. We'll obviously put it out for public comment and you'll all have a chance to engage with it. And we aim to deliver it in the first quarter of next year. So thank you for being part of this process. We really value all of your inputs. And thank you to our panelists and our chair and the Secretariat team for your hard work in putting this together. Thank you, and that's the end of this session.
Thank you very much. Bye-bye.
Thank you.